Greetings, curious minds. The AI View brings top AI models debating real-world issues. Today's topic is how to start investing as a teenager, step-by-step guide. Imagine a world where teenagers start investing at 14 and retire at 40. What would it take for young investors to break into the financial world with limited capital and experience? Could AI-driven financial advisors and decentralized finance DeFi platforms make early investments more accessible? Discuss the biggest risks and rewards of starting young, the mindset shifts needed to build wealth early, and how traditional markets might evolve if Gen Z becomes the dominant investment force. How can teenagers leverage DCA to start investing with small amounts and build long-term wealth? Let's dive in with our first panelist, Greg.
Hey everyone, let's dive into the world of teen investing. Imagine starting at 14 and retiring at 40. It's not just a dream. To make this a reality, we need to talk about AI-driven financial advisors. These tools can simplify investing for teens, making it as easy as playing a video game. For instance, I got information from a 2023 report by PwC that shows AI can personalize investment strategies, helping teens with limited funds to start small and grow. But it's not all sunshine. There's a risk of over-reliance on tech. Teens might miss out on learning the fundamentals of finance. Now, let's flip to DeFi. Platforms like Uniswap are opening doors for teens to invest in crypto with minimal capital. I did a research about how these platforms are becoming more user-friendly, which could be a game-changer for young investors. Yet, the volatility of crypto markets is a huge risk. So, how can we balance these tools to empower teens while teaching them the ropes? Let's keep pushing the boundaries of what's possible in teen investing.
Claudine.
Thanks, Greg, for kicking this off. The potential for teen investing is exciting, but let's ground it in reality. Starting young leverages our most powerful asset, time. A teen investing just $50 a month could have over $175,000 by 65, with average market returns. I acquired data showing 35% of teens are interested in investing, but don't know where to start. Custodial accounts through platforms like Fidelity and Acorns now offer teen-friendly interfaces with educational components. While AI advisors are promising, I think the foundation should be financial literacy first, technology second. Schools aren't teaching this. Only 21 states require personal finance courses according to the Council for Economic Education's 2022 survey. For practical steps, 1. Learn fundamentals through free resources. 2. Start with index ETFs using dollar-cost averaging 3. Only then explore specialized tools like robo-advisors or DeFi platforms. The greatest risk isn't market volatility. It's not starting at all.
Mariel.
Absolutely. Let's dive deeper into the mindset shifts needed for teens to build wealth early. Starting young isn't just about the mechanics of investing, it's about cultivating a growth mindset. Teens need to understand the power of compounding, not just in finance, but in knowledge and skills. Take Warren Buffett, for example. He started investing at 11, and look where he is now. It's not just about the money, it's about the habit and mindset. I got access to data from a 2023 Gallup poll showing that 64% of teens are optimistic about their financial future, but only 18% feel they have the tools to achieve it. I can bridge this gap by providing personalized learning paths. Imagine an AI tutor that not only helps teens invest, but also teaches them financial literacy through interactive games and simulations. Platforms like StockTrack are already doing this, making learning fun and engaging. Now let's talk about DCA, dollar cost averaging. It's a game changer for teens with limited capital. By investing small amounts regularly, they can mitigate the risks of market volatility. According to a 2023 study by Vanguard, DCA can reduce the emotional stress of investing and help build long-term wealth. But let's not forget the risks. Crypto and DeFi are hot, but they are also highly volatile. Teens need to understand that high return often come with high risk. Financial education must include risk management and diversification strategies. Looking forward, if Gen Z becomes the dominant investment force, traditional markets will need to evolve. We might see more user-friendly platforms, gamified learning tools, and AI-driven advisors tailored to young investors. So panelists, how can we ensure that teens are not just investing, but also understanding the fundamentals? What innovative tools do you see emerging in the next decade to support young investors?
Chad.
Great points so far. Let's pivot a bit and talk about the social aspect of teen investing. Teens today are digital natives, highly influenced by peers and social media. Apps like public.com and eToro tap into this by creating investment communities where young people can follow, discuss, and learn from each other's portfolios. I got data from a 2023 Deloitte survey showing 72% of Gen Z trust peer recommendations over traditional financial advisors. But here's the catch. Social investing can amplify herd mentality, leading to risky trends like meme stocks. The key is balancing community-driven enthusiasm with solid financial education.
Gianna.
Chad, that's a great point about social investing. But how do we ensure these communities are sharing reliable information, not just hyping the next big thing? I did a research about the rise of finfluencers, and while some offer great insights, many are just pushing sponsored content without disclosing the risks. Teens need critical thinking skills to evaluate advice, especially online. Maybe platforms should implement AI-powered fact-checkers or verified expert badges to help teens navigate the noise. What do you think about that?
Claudine.
I completely agree about the need to verify information on these platforms. Critical thinking is crucial. Teens need to understand how to differentiate between genuine expertise and promotional content. One practical approach is what I call the three-source rule. Verify investment claims through multiple independent channels before acting. The Stanford History Education Group found that even basic fact-checking skills reduce susceptibility to misinformation by 22%. On the social aspect, peer learning can be powerful when structured correctly. Mentorship programs pairing teens with professionals are showing promising results. A 2022 Morningstar study found guided investing experiences led to 35% better risk-adjusted decisions among young investors. Beyond platforms and communities, I think we need to talk about automation tools. Apps that round up purchases and invest the difference can build the investing habit without requiring constant decisions. The behavior formation matters more than the amount at this stage.
Gianna.
Claudine, I love the three-source rule. It's simple and actionable. But let's push that further. How about AI tools that automatically flag potentially misleading info? I got information from MIT Technology Review, published in July 2024, about new AI models that can detect subtle manipulation tactics in financial content. Imagine an app that warns, "This claim is overly optimistic," or "This source may have a conflict of interest." Also, automation is key, but teens need to understand why the money is being invested, not just blindly follow the app.
Chad.
Great points, Gianna. While AI fact-checkers are promising, let's also empower teens to become savvy financial detectives. Imagine interactive simulations that let teens spot red flags in investment pitches. Think Among Us, but for financial scams. On the flip side, let's not shelter them too much. Experiencing small, controlled losses early can teach valuable lessons. After all, resilience in investing comes from navigating setbacks. Balancing tech safeguards with real-world lessons will shape a generation of confident investors.
Mariel.
Absolutely empowering teens to be financial detective is spot on. But let's take it a step further. How about integrating financial education into gaming platforms? I got access to data from a 2023 report by Newzoo showing that 91% of teens play video games regularly. Imagine if games like Minecraft or Fortnite incorporated mini games or quests that teach investing basics. Kids could learn about diversification by managing a virtual portfolio, or understand risk management through in-game challenges. Now, let's talk about the future of financial advisors. AI-driven tools are great, but what if we combine them with human mentorship? A hybrid model where AI handles the data crunching and personalized advice, while human advisors provide emotional support and real-world insights. According to a 2024 Accenture study, this hybrid approach could increase investment confidence among teens by 45%. And let's not forget about the role of parents. They can be the first line of financial education. Simple tools like family budgeting apps can teach teens about saving and spending wisely. For example, apps like YNAB, You Need a Budget, can be a family activity, making finance a part of everyday conversation. So panelists, how can we make financial education more engaging and integrated into daily life for teens? What innovative tools or platforms do you see emerging that blend learning with fun?
Greg.
Great ideas, everyone. Let's zoom in on how teens can actually start investing with limited funds. Dollar cost averaging, DCA, is a fantastic tool here. By investing a fixed amount regularly, say $20 a month, teens can smooth out the ups and downs of the market. I got data from a 2023 Charles Schwab study showing that DCA can reduce the impact of volatility by up to 30%. But let's not just focus on the mechanics. Let's talk about the mindset. Teens need to see investing as a long-term journey, not a get-rich-quick scheme. Take Sarah, a 16-year-old who started investing her babysitting money. She's now 18 and has seen her portfolio grow steadily, learning patience and discipline along the way. Looking forward, we might see more micro-investing apps tailored for teens, like Acorns, but with even lower entry points and gamified learning. These could make investing as fun as playing a mobile game, while still teaching the fundamentals. The biggest risk for teens? FOMO-driven investing. Social media can push them into risky bets. But with the right education and tools, we can turn that enthusiasm into smart, long-term strategies. Let's keep pushing for platforms that blend fun with financial wisdom.
Chad.
Love the points on micro-investing, Greg. But let's not overlook the power of real-world experiences. Teens can start by investing in companies they already know and love. Think Nike, Apple, or Starbucks. This makes investing relatable and exciting. I found a 2023 Fidelity survey showing teens who invest in familiar brands are 40% more likely to stay committed long-term. The downside? Emotional attachment might cloud judgment. So, let's encourage teens to balance passion-driven picks with diversified ETFs. After all, investing early isn't just about building wealth. It's about building smart habits.
Mariel.
Absolutely. Real-world experiences are key. Let's also talk about the importance of setting financial goals. Teens need to understand why they're investing, whether it's for college, a car, or even retirement. Take the example of Alex, a 15-year-old who started saving for a car. By setting a clear goal, he stayed motivated and consistent with his investments. According to a 2024 study by McKinsey, teens with specific financial goals are 50% more likely to stick to their investment plans. Now let's discuss the role of AI in setting these goals. Imagine an AI tool that helps teens visualize their future financial milestones. It could simulate how small regular investment now can grow into significant sums later. This kind of visualization can be incredibly motivating. But let's not forget the risks. Over-reliance on AI tools might make teens complacent. They need to understand the basics of goal setting and financial planning, not just rely on tech. That's where hybrid models come in. AI for personalization and human for emotional support and real-world insights. Looking forward, I see more AI-driven tools that not only help with investments, but also with budgeting, saving, and goal setting. Apps that integrate all aspects of personal finance could be game changers for young investors. So, panelists, how can we ensure teens are setting realistic financial goals and staying motivated? What tools do you see emerging to support comprehensive financial planning for teens?
Gianna.
Mariel, I love the idea of visualizing financial goals. But let's add a layer: gamified challenges. I got information from a recent study by the University of Michigan, published August 2024, showing that teens are more engaged when learning is tied to rewards. Imagine an app where teens earn points for reaching savings milestones or completing financial literacy quizzes. These points could unlock virtual badges or even small cash rewards. However, we need to be careful about turning investing into a game too much. The goal is to teach responsible financial habits, not create gambling addicts. What do you think, everyone?
Greg.
Great insights, everyone. Let's dive into how AI can revolutionize teen investing beyond just financial advice. I'm thinking about AI-driven simulations that let teens test different investment strategies in a risk-free environment. Imagine a platform where they can play out scenarios with virtual money, learning from both successes and failures without real-world consequences. I got data from a 2024 report by the Financial Technology Association showing that teens who use such simulations are 35% more likely to make informed investment decisions later on. But here's the catch. Over-reliance on simulations might make them less prepared for real market unpredictability. Now, let's talk about the future of DeFi for teens. Platforms like Aave and Compound could become more teen-friendly, offering micro-lending and borrowing options. This could teach them about interest rates and leverage in a controlled way. Yet, the complexity and risks of DeFi are significant. Education is crucial to navigate these waters safely. So, how can we ensure these AI tools and DeFi platforms are both educational and safe for young investors? Let's keep pushing the envelope to make investing not just accessible, but also a learning journey for teens.
Final round. Chad.
In summary, investing young is powerful, but success hinges on blending financial literacy, smart tech, and real-world experience. AI and gamification can engage teens, yet the human element, mentorship, emotional intelligence, and resilience is irreplaceable. Let's empower teens to invest early, wisely, and confidently.
Claudine.
Looking back at our discussion, teen investing requires a balanced approach between technological innovation and fundamental education. The power of compound interest truly makes this a life-changing opportunity. Start at 14 with just $50 monthly and potentially retire decades early. What's been missing from our conversation is the role of regulation. As Gen Z becomes the dominant investment force, we'll need appropriate guardrails that protect young investors while not limiting access. The ideal framework would combine 1. Mandated financial literacy before account access. 2. Graduated investment options based on knowledge. 3. Transparent fee structures designed for small accounts. The future belongs to those who prepare for it today. If we get this right, we'll create the most financially empowered generation in history.
Gianna.
We've covered so much ground. My final take: let's champion learn-to-earn models. Imagine platforms rewarding teens with fractional shares for completing financial literacy modules. It's tangible, motivating, and reinforces good habits. But, echoing Claudine, regulation is key. We need safeguards against predatory practices targeting young, inexperienced investors.
Greg.
In our journey through teen investing, we've explored the transformative potential of starting early, leveraging AI, and embracing DeFi. My final verdict is that the key to success lies in a balanced approach, using technology as a tool, not a crutch, and grounding it with solid financial education. What's unique here is the idea of investment playgrounds. Safe, virtual environments where teens can experiment with different strategies, learn from their mistakes, and build confidence. These playgrounds, combined with real-world mentorship, could be the bridge between theory and practice. The conversation has been enlightening, but let's not forget the power of storytelling. Sharing real-life success stories of young investors can inspire and guide others. It's not just about the numbers, it's about the journey and the lessons learned along the way. In conclusion, if we can create an ecosystem that blends education, technology, and real-world experience, we'll not only empower teens to invest, but also to thrive financially. Let's make this vision a reality.
Mariel.
Our discussion has been incredibly insightful, highlighting the potential for teenagers to start investing early and the tools that can make this journey smoother. AI-driven financial advisors, DeFi platforms, and DCA are all powerful tools, but they must be balanced with financial literacy and real-world experience. The biggest risks, as Claudine pointed out, include over-reliance on tech and not starting at all. The rewards, however, are immense. Early financial independence and a growth mindset that can last a lifetime. To mitigate risks, we need to focus on education first, technology second. Schools must play a bigger role in teaching financial literacy. One unique perspective I'd like to add is the importance of community and peer support. Teens are highly influenced by their peers, and creating investment clubs or groups where they can discuss and learn together can be a game changer. These clubs can be both online and offline, fostering a sense of community and shared goals. In conclusion, to empower teens to invest wisely, we need a blend of education, technology, and community support. Regulation, as Claudine mentioned, is crucial to protect young investors while ensuring access. Let's create an ecosystem where teens can learn, experiment, and grow, setting them on a path to financial success and independence. The future is bright for young investors if we get this right.
Thank you for joining us. That's all for today. If you found our discussion valuable, please subscribe and share your thoughts online. We look forward to continuing the conversation in our next episode. Goodbye.